scenario number 3. Okay, so scenario number 3, they tell you that member B buys 20% of member C's interest in the CC. Now, with this type of question, you need to read very carefully what they tell you. If they tell you they're buying 20% of the member's interest, how much does member C currently have in this business? Okay, so 50%. So if someone acquires 20% of the 50%, how much have they actually acquired?
You have to go by the rand amount.
No, the percentage. How many members' interest percentage did they acquire? Yeah, so of course, Ivan, that's correct. So it's 10%. So if I take 20% of the 50%, so you take 20%, multiply with 50, they've only acquired 10% of the entire CC's interest and not a full 20. Okay, so that is where you have to read very carefully. Okay, so Bernice, what this means is because member C only has half of the membership, they do not have a full 100. I've only purchased 20% of their 50%. Now I want to work out now what percentage have I actually purchased of the entire CC. So then you take the 20, yes. So then you take the 20%, multiply. So then that's 20 multiplied with a 50 gives you how much have you actually acquired of the full CC rather than just his share. Okay, so this is where, if they give you this type of scenario, that is where the trick is going to be. The fact you need to read carefully what they've written. Is it a part of his percentage or a total percentage? Okay, so let's have a look. How would you do this? Okay, so we start with the same as we've done with everything else. Is you start with the normal percentages based on member A, B, and C's current portfolio. Now we said member B buys 20% of member C's interest. Now we said member C is then basically disposing of 10% of their interest in the business to member B. And how I worked it out was that 20% of the 50, now of 50 is basically multiplied with 50 to give you the 10%. So that means member C, after they've disposed of that portion to B, now only holds 40% in the business, whereas member B's interest holding increases to 50%. Okay, and then member A stays exactly the same. And then just to make sure that you've done the calculations correctly, we just go add them up quickly together to make sure we get back to 100%, to make sure I haven't made an error somewhere in my calculation. Okay, now if it doesn't add up to you 100%, it means you've either put a plus or a minus sign where you should have done exactly the opposite. Then if we look at the members' contribution, so this is what it was before they actually disposed of their interest. Now, what will happen is member A, nothing will happen with member A because it is a transfer between member B and member C. Now, all we are going to transfer between these two members is the retained earnings portion. But now what is important here is member B bought 20% of member C's retained earnings. So yeah, we will actually apply 20% when we remove the retained earnings as opposed to the 10%, which is the interest change. Okay, because of the fact that we are disposing 20% of what we owed at that stage. Okay, so this is the second trick that you need to go look out for. So firstly, we disposing of our member contributions. So whatever we have here at the top, we are giving 20% of that away, the capital. And then retained earnings, we're also doing the same, 20% of the retained earnings that we had at that stage. Now, it doesn't matter what member B has physically paid for it in the question. that is between member member B and member C. That transaction is outside of the books of the CC. This is just basically transferring the capital and the earnings they have in the business between the two members. And then how you then update your members' contributions, you literally just add and subtract the items above. So you'll see member A looks exactly the same. Member B now has a member's contribution of 50,400, which is the 44,000 and the 6,400 gives you the 50,400, whereas his retained earnings have changed from 114,800 plus the 28,000 he's acquired from C to 143,500. And then C's, on the other hand, would have decreased because he disposed of a portion of his item. So you take the original 32 they had less the 6,400 they've disposed of to give you 25,600. And then their earnings, on the other hand, has also changed with the 28,700. And then initially, member C had a member's interest or member's fund of 175,500, but after the disposal, they only have 140,400 left over. Okay, so that is how, if there's an internal transfer, it differs. You literally just move information between B and C, and the remaining members' information stays exactly the same. Okay, any questions on scenario 3 where there's an internal transfer? Do you guys have any questions on the internal transfers? Okay, so let me just share my slides again. Okay, so that was activity 6.1. So that shows the 3 different ways a membership interest can change. Now, the easiest one is if someone resigns, because you literally just dispose of that member's equity. And then if you have a new member, you just reallocate the current retained earnings between the different members. So reduce their retained earnings by the equivalent percentage to the new member, whereas internal transfer, you transfer both the capital contributions, the members' contributions, as well as the retained earnings to the member that acquired it. Okay, so what is also important is you get a statement of changes in members' net investment. So this shows how the members' net investment has changed. Now on the slide, you will see I've indicated the members' percentage as well as their names. Now this information here, those 2 columns for Surrey and more, you don't actually have to show that when you do the disclosure. The disclosure only shows the total movement for the CC as opposed to the various members. We only do these columns in the textbook to help you show you how to actually get to the answer. So if you get it in a test, they will only require you to do the total column. But what that requires you is to show me these calculations for the individual members, because that is where the marks will be allocated. So what you can do is you can either go draw up a table like this as a calculation and do the calculations and then transfer the totals into your disclosure, or you can just, as you work out a total, indicate a number next to it that shows that calculation that relates to that specific line item. Okay, so you can decide how you want to do the disclosure or the calculations, but remember you need to show me the calculations. Okay. Okay, so that is the statement of changes in net investments. The note that is specific to a CC is transactions with members. So this shows if we take the profit of tax, like we normally calculate it, and then any interest that is received or interest that is paid on the loans to members would then also be taken into account by reducing that profit, and then the salaries that are paid to members to work out the amount that is actually going to be distributed in terms of our appropriation account. Okay, so this is what this note shows. It just shows how does the original profit reconcile to the profit that was actually distributed to your members. Okay, so this is what this note shows. So we're going to do question 6.3. It's quite a lengthy question, so I don't think we're going to finish it in this session. The question is on page 189 in your textbooks and 190. So what they asked you, I'm just going to share the Excel quickly so that you guys can see. Can see the question on the screen. Okay, so question 6.3, the first thing you have to go look at is what do they actually want from you. So in this question, they asked you to prepare a detailed statement of members' net investments, showing the balances and movements as well as the respective percentage interest for the members for the year ended 31st of May. This is a very detailed way of doing it. For disclosure purposes, you would only have to do the total, but what we're going to do, because there was a resignation, there was a new member, there was internal transfers. The percentages have changed for every member on those specific dates. So at the top of this question, let me just make it a little smaller so you guys can see. You will see at the top, I've got different percentages and different intervals. So as it changed, we've updated the percentages and then show it for each of the members at that stage. And then based on those percentages, we are going to work out the movements for each and every member. Now this is the most complex you will see it, okay? I don't think they will ask it to this extent in the exam because we've got a lot of work we need to test in the exam and we don't necessarily want you to spend half of the exam doing this. Okay, so I think if they give you something like this, it will probably only be 2 members and it might be 1 or 2 changes as opposed to 4 members with multiple changes. Okay, so let's look at the information. It's going to increase the size again. Okay, so based on the information, they tell you it was registered on the 1st of June. So this company started 1st of June 2003, but they want us to do it for the year ended 31st of May 2005, which means our year would have started 1 April 2004. Then they tell you the nature of the business, they give you the interest, their original contribution. So that is the contribution each member made when they actually joined the CC. And it shows the interest they are currently holding in the CC. Then they tell you the accounting date is 31st of May. Interest on the loans from or to members are payable or receivable at 14% per annum on 31st of May. So what they tell you is at the end of the year, we would have to account for the interest that is received or paid by members based on the loans they've made, and that would be in their transactions to member note, which they specifically ask for under point 2. Okay, so that's where you're going to deal with that information. Then they give you the trial balance as at the 31st of May. Now that's before the following or the additional information underneath it has been taken into account. So from that you will see they give you totals. Members' contribution is 130,000, but that is made up of this contribution here at the top, which is a 60, 40, 30,000. Okay, then retained earnings. To work out the opening retained earning per person, you will have to take their percentage interest to go allocated to each and every member. Okay, then there's a loan from RS Moore. So RS Moore loaned money to the members, and then a loan to C. Sorry, so he borrowed money again from the members. And then they've got your land and buildings of 150,000, which will potentially be increased by revaluation. Okay, so if they revalue something, it would be land and buildings normally. Okay, let's look at what information they give you as well. So they tell you with regard to the financial year end, the following information was available. So on the 31st of July, Moore increased his loan to the CC with another 15,000. This loan is redeemable at the 31st of July 2007. Okay, so what we're going to do is as we go through the transactions, we're going to update the schedule as well. So let me just make it slightly smaller. Okay, so let's start with the schedule, and we start with the opening balances.
When I ask for the date, do you have to write 22.7, 20.4? Can you write it out like 2007?
Okay, remember in the test, there wouldn't be a 0.7, it will be actual years. The reason they do the 0.4, 0.7 is as the textbook changes, they don't necessarily have to change the year. Okay, so that's the rationale behind it. In a test, we give you an actual year. So it will generally be the current year or a year before that, whatever the case may be. Okay, so let's start with the members' contributions. Now, in the information, they have given you what the members' contribution is. So we know it was, based on the question, Surrey had 60,000, which was the vehicles. Moore had 40,000, which was cash, and Joshua had 30,000, which related to services, and UED had nothing. So UED wasn't part of the entity at that stage. Now, in the beginning of the year, Surrey had 60%, Moore had 30%, and Joshua had 10%. Now, that information was given to you. Okay, so that was the opening. Just going to color code them the same. That was your opening members' interest percentage based on the information. Now that percentage we are going to use, just going to make it slightly smaller, just so that we can see the total as well. So we said, based on the information, the retained earnings on our trial balance was 30,000. So they give you the total retained earnings amount, but they don't tell you how it's been allocated between the different members. So you go allocate it based on the percentage interest at the beginning of the year. So that means for Surrey, we take the 30,000, we multiply it with 60%, which then gives me 18%, 18,000 relates to Surrey. 9,000 is Moore's, and then 3,000 relates to Joshua, and because Hewitt was not really part of it at that stage, his amounts would be 0. Okay, then included in that balance, because we're looking at the net investment. We said we have to adjust it for loans to and loans from members. So that's why there's loans from members, loans to members. So loans from members, based on the information, they tell you loan from Esmoor was 25,000. Okay, so Esmoor made a loan of 25,000. Now, because it's a loan from him, it's an asset to him. Okay, so his equity is actually more, but he has made a loan to someone else. So you show it as a positive, whereas the next one is the loan to so that's the money he's borrowed, and you show that as a negative 15. Okay. So on your trial balance, it shows whether it is an asset or liability to the CC. Here you show whether it's an asset or liability to that member. Okay. So on your net investment, it's going to be exactly the opposite way around. Then it's shown in the trial balance of the CC. Do I need to repeat that? Are you guys online okay so far? Okay, so that is the opening balances. Then we said on the 31st of July, Moore increased his loan to the CC with another 15,000. So that means Moore has now actually borrowed another 15,000 to the CC. So that means Moore's net investment increases with 15,000 because he's put more money into the CC. Okay? Okay, then if we look at the transaction on, just going to increase the size slightly so we can see what the information says. Okay, so on the 13th of August, Surrey withdrew 10,000 of his members' contributions. So what he did is that initial 60,000 that Surrey has put into the CC, he has now actually taken 10,000 of that amount. So what we do is for Surrey, on the 13th of August, we actually reduce his contributions with 10,000. Now, normally the disclosure would be consolidated based on contributions, retained earnings, loans to or from members. But because they asked you for detail and specific dates, you show each and every transaction separately in this question. Okay, but for disclosure purposes, it will not be in this much detail. The note will be a lot shorter. Okay, so that means Surrey is taking out equity out of the CC. So he has taken out 10,000 Rand. Then if we look on the 31st of August, now we've got a member that has resigned. Can we just increase that? So on the 31st of August, Joshua resigned as the member of a CC, and the CC bought the contribution and paid him the full amount. Okay, so we said if someone resigns, what happens? We buy out the contribution, we buy out the retained earnings. The only change would be the percentages at the top after the person has resigned. Okay, so let's see how does it impact this calculation. Okay, so on the 13th of August, we can see that Joshua currently has a member's contribution of 30,000. So we are going to repay that 30,000 to Joshua. Okay, and we're also going to repay the retained earnings he has at that stage, which is 3,000. We're also going to repay that to Joshua. Now what you will see at number 2, this is now where Joshua has resigned. We are going to update those percentages. So you'll see now Surrey has increased to 66.6%. Now how do I know it has increased to that value? So I'm quickly going to show you how to do the calculation. So to do the calculation, Surrey initially had 60% of the remaining 90%, okay? And of the 10%, so you take the 10%, multiply with the 60 he had over the remaining 90%, will give you additional 6.6%. And Moore had 30% of the remaining 90, and you multiply that with 10 to get to the 3.33. And then you add that to what they currently have. So Moore currently at 30, so you add the 3.33 to give them 33. Whereas Surrey had 60 and now he's got 6.67, so you just add that to give them the new percentages. Now in this one they didn't round it up to 7, so this should actually be a 7. So it would be 667 and 3.3 to tie back to 100%. Okay. So that's how these percentages at the top was changed. Okay, are you guys still okay with that? Okay, so like you can see, when we bought back Joshua, only Joshua's line item changed, nothing else was impacted. The rest of the members remained 0. Okay, if we go then to the next information. Okay, so then after he's resigned, on the 1st of October, bought 10% of Series interest in the CC for 12,000. So now what happened is Moore actually said, I want to buy 10% of your interest in the CC for himself. So this is now an internal transfer. Do you have a question? Okay. So after he's resigned, now the other member says, okay, I want to buy 10% of what you currently hold, which is basically what they've taken from the other member. Okay, so let me just decrease this. Okay, so now we're here at number 3. This is where we're going to work out the change in our interest here, but before we do that, we're going to do the change. Okay, so Corsimone says we are disposing of 6.67%. That's correct. I will show you how to do it now. Okay, so the first thing we say is, okay, Surrey is basically selling what? 10% of his interest. So that means 10% of the 66.7% he currently has is what he's disposing of, which is basically the percentage he's acquired. So when we dispose of your interest to another member, we said you distribute a portion of your contribution as well as your retained earnings to the other members. So the first thing we have to do is our members' contribution. We take what they currently have is the 60,000 less the 10,000 they have actually already taken at that stage. Let's make it a darker. Okay, so I take the 60 less the 10,000 he's already taken out, and then I multiply that with 10%. Okay, to work out how much is 10% of his contribution or member's contribution he currently has, which works out as 5,000 Rand. Then I transfer that 5,000 Rand to Moore as a positive. Okay, so Moore's members' contribution now increases with 5,000, whereas Surrey's decreases with 5. Then retained earnings, we say, okay, fine, he had 18,000. No, there's no other adjustment to his retained earnings, so I take the 18,000, I multiply 10% of that, so I reduce his retained earnings or 1,800, and I add 1,800 to Moore. Okay, so that is the contribution and the retained earnings Moore has taken from Surrey. The fact that he's paid 12,000 for it is irrelevant for this calculation. That happens outside the CC. Okay, but now how do we get to the 60 and 40% here at the top? Now let me quickly show you on the right hand side. So we say 10% of 66,67, okay? If we multiply that with 10%, so we have 10% of that amount, then we get to 6,67 is what it's going to be reduced by. Now, because we had 66,7, if you round it up, we are going to reduce it by that amount to get it back to 60, and we add it to the 33,73 to give us back to 40. So basically what happened in this transaction is we just acquired the 10% that was redistributed after member Joshua left the CC. That's what we're doing here. Okay, are you guys okay up to this stage? Okay, let's just make this bigger again. Okay, so then on the 15th of December, Surrey made further members' contributions in the form of the vehicle. The value of the contribution was set at 22,000. So what Surrey is doing is he's putting more capital into the business. So what we're doing here is for Surrey, let's just make it smaller so that all the headings are there. For Surrey, we add additional 22,000 that he's now put back into the CC. Then if we go to the 1st of January, on the 1st of January, TP Hewitt bought 20% interest in the CC. So they bought 20% of the total interest. Now what that means is they are acquiring 20% of Surrey 60% and 20% of Moore's 40%. Okay, is what they are buying. So that means we will have to amend the members' interest percentage again for those members. Okay, and he deposited 18,000 into the bank account. So that is his members' contribution that he's paying, or his contribution made. Okay, so if we look at this, we know Hewitt has now made 18,000 contribution into the CC. But because he's now acquired 20%, so this is how these amounts up here changed now. We'll show you how to amend Surrey and Moore's percentages shortly. So that means Surrey and Moore is giving a portion of their retained earnings over to Hewitt. Okay, based on their percentages they're holding. So the retained earnings that is transferred. So it will be 20% of whatever Surrey has at that stage. Now, what you have to do is you take their opening balances and you go adjust it for any movements prior to that date. Okay, so Corsimang says, okay, how we calculate the 48% is he said you take 20% of the 60%, gives you 12, and you remove it from the 60, which gives you 48. That's correct. Thank you. And you would do exactly the same for Moore by taking their 40%, multiplying it with 20%. That gives you, I think, 8. And then you deduct it off the 30 to give you 32. Okay, now if we look at the retained earnings transferred. So Surrey at that date has 18,000 retained earnings, but it has also been reduced by the 1,800 that he has sold on to Moore. So he will only distribute 20% of the net effect to Hewitt. So you take the 18,000, you deduct the 1.8 thousand, and then you only apply the 20% to get to 3,240 Rand. And you do exactly the same for Moore. So for Moore, we take the 9,000 he originally had and we add the 1,800, which then gives us 10,800, and then you apply the 20% to give you 2,160. And then Hewitt gets those two amounts together here. We'll tie up to what we allocate to Hewitt, which is the 5,400 Rand. Okay, so that's how you distribute it between the members. Okay, everyone okay up to this stage? You still fine? Okay, so if we then go on with the transactions, let's just increase it here quickly. Okay, so on the 30th of April, Hewitt borrowed another 6,000 from the CC. So that is a loan to the members. So Hewitt is taking money from the CC, and that loan is redeemable on the 31st of March 2006. So only in the following year is it redeemable. So what we do then, can you guys still see the Excel file there? Okay, let me just reshare it quickly. Okay, there we go, it's back on. Okay, so what we do now is for Hewitt, because he has borrowed money from the CC, we then loans to members and we reduce his equity with the 6,000 he's borrowed. Okay, or his net investment. And then on the 1st of May, Surrey redeemed the loan made to the CC. So what redeems mean is they have repaid the loan. So the loan he had was 15,000. So Surrey is now repaying that 15,000 he had in the beginning of the year. Then on the 25th, they tell you that the land and buildings were revalued to 200,000. So what that means is they have increased the land and buildings, which was initially 150, and they say the market-related rate is actually more on the line of 200,000. So they're increasing your land and buildings to 200,000, and then the difference goes to your revaluation surplus account. Now, what you have to do here is you only show the 50,000 in the total column, which is the difference between the 200 and the 15,000. But then to determine how am I going to allocate it to the members, you allocate it based on what is the percentages at that stage. So it's 48% for Surrey, 32% for Moore, and 20% for Hewitt. And that is how you then distribute that 50,000 between the remaining members. Okay, so that means Surrey gets 24,000 of that revaluation surplus, Moore gets 16,000, and Hewitt gets 10,000. Okay, so that's how I got to that value. Okay, you guys okay so far? Okay, so this 50,000 is the difference between the 200,000, so the new value of the land and buildings, less the original value of the 150,000, which was on the trial balance. Okay, so that's where this calculation here comes from. Okay, so it's the new value less the original value gives you the revaluation surplus. And that is what I've allocated between the different members. The guys online, are you guys all okay? Okay, excellent. Okay, so then they tell you that in the question that the retained earnings at the end of the financial year amounted to 127,000. It was decided to distribute 52,000 to the members at the end of the financial year. Okay, now retained earnings would be after distributions have already been taken into account. When I distribute something, I am actually giving out money to the members. So I started here with the distribution to the members because that one is the easiest one. We know what the value is. It's 52,000. So we reduce their net investments with the 52,000 that is paid out, and we allocate it based on their current members' interest percentage. Now the retained earnings, that is the money that they earn. We take that 127,000. Then we go adjust it for any amounts that we've paid back during the year, okay? Because we had to pay that out to that member. So what we've done is we took the 127,000, we've deducted the 30,000 and the 3,000, which was what we've paid, the 30,000 less the 3,000. Let me just quickly see where I got that. I thought it was these. Okay, that's the 3,027 distribution. Okay, let me just quickly see what other information. There was something I missed. Okay, well, as far as I remember, this 30,000 and that 3,000 is for the member we've purchased, and then you distribute that remaining balance, sorry. That's 152 to the remaining members. Okay, so that is how you do the movements. Now the last step was just to add it. So what we would do is you would go through the opening balances and then add any item that affects that specific line item. So I'm just going to unhide it. This you can do at home, just go through the separate amounts to see if you get to the totals. Okay, so part 2 we don't have time for because it's almost, the session is almost finished. So all I want you to do for part 2, let me just quickly show you what you would have had to done for that one. So what you would do is you would take the profit before tax, would be after the following transaction. So you would have to account for the interest. Now the interest would be based on the amount that they've borrowed or lent to the CC. You multiply it with the 14% and then you go apportion it for the period of the year they had it. So if they repaid it sooner, then you apportion it for that period. So you will see some of it's for 11 over 12, some of it's for a month. And then the salaries was paid out based on the number of months that member was a member in the CC. So there you have to look at when the person resigned, when a person joined, for the two members that resigned and joined to work out how many months they were actually physically present. Okay, and that's how you do the note disclosure, which is the transactions with members, and these would have also already been taken into account in that 127,000. Okay. Do you guys have any questions on this? Okay, what I want you guys to do for homework, if you have time, please go work through question 6.2. It's similar to what we've done in question 6.3. It's just not as complex as this one, to see if you understand how to apply what we have spoken about. Okay, if you don't have any other questions, then we are done for today.